Every syndication deal comes with a deal summary. It might be a 2-page PDF, a slick slide deck, or a detailed investor memo. Most LPs read the summary the same way. They go straight to the returns section, see the projected IRR and equity multiple, and decide whether the deal is interesting. That's the wrong way to read a deal summary. The projected returns are the conclusion of the analysis. They're only meaningful if the assumptions behind them are sound. A deal projecting a 20% IRR with aggressive rent growth, an optimistic cap rate at exit, and a short hold timeline can look better on paper than a deal projecting 14% with conservative assumptions that will actually deliver. In this video I'm going to give you the 10 numbers that actually tell you what's underneath the headline, and what each one should look like on a well underwritten deal. Number 1, purchase price per unit, for multifamily, or per square foot, for commercial. Before you look at returns, look at what the GP paid relative to the market. Is the purchase price in line with comparable sales? Below market, why? Above market, what assumptions justify it? If the GP is paying above market pricing, the deal's entire return thesis depends on the value-add plan executing perfectly. Conservative underwriters don't pay full price and then project full upside. For multifamily, look up comparable sales in that submarket on CoStar, Redfin, or publicly available MLS data. If the GP paid $250,000 per unit in a market where comparable properties trade at $200,000, the risk tolerance is baked in from day one. Number 2, the going-in cap rate. The capitalization rate at purchase, NOI divided by purchase price. A deal purchased at a 5 cap means you're paying 20 times the net operating income. A 6 cap is roughly 16 times NOI. Compare the going-in cap rate to the submarket average for that asset type. If the submarket trades at 6.5 caps and this deal was purchased at a 5 cap, the GP either sees significant value-add upside, or they overpaid. Going-in cap rate also sets your downside anchor. If the market softens and cap rates expand by 100 basis points at exit, a 5 cap exit assumption becomes a 6 cap exit, and the sale price drops significantly on the same income. Number 3, projected exit cap rate. This is one of the most important numbers in any deal summary, and the one most often glossed over. The exit cap rate is the GP's assumption about what the market will pay for the asset at exit. A lower exit cap means a higher sale price on the same income. Red flag, exit cap rate lower than going-in cap rate, with no specific justification. The market will appreciate is not a justification. A deal that bought at a 6 cap and is projecting a 5.5 cap exit in a flat or rising rate environment has baked appreciation directly into the projected return. Conservative underwriters assume cap rate expansion, exiting at a higher cap than purchase. This is the right posture when you don't know the future interest rate environment. Ask what cap rate is assumed at exit and compare it to the going-in cap and current market data. Number 4, projected rent growth. The deal's revenue projections depend on rent growth assumptions. What is the GP assuming rents will do annually over the hold? Current market, look at what actual rent growth looks like in that submarket year over year. If the market is running at -1% and the deal is underwriting 3%, that's a gap that needs justification. Ask for the rent growth assumption in the model, not just what's on the summary slide. Some GPs bury the assumption in the pro forma. If they can't tell you the specific annual rent growth assumption in their model, they don't understand their own underwriting. Conservative underwriters project 0 to 1% rent growth, stress test at -2%, and let favorable market conditions add upside beyond the model. Number 5, debt service coverage ratio, DSCR, at stabilization. DSCR equals net operating income divided by debt service. A DSCR of 1.20 means the property generates 20% more income than it needs to cover the mortgage. A DSCR of 1.05 means there's almost no cushion. For a stabilized multifamily property, you want to see DSCR above 1.25 at stabilization, and ideally above 1.40. Many lenders require 1.25 as a covenant threshold, below that, you're at risk of triggering a technical default. Ask what the DSCR is today, if the deal is occupied, and what it's projected to be post-renovation and stabilization. A deal that achieves stabilization DSCR of 1.15 has limited buffer for any income shortfall. Number 6, Loan-to-Value Ratio, LTV, and Loan Terms. LTV is the loan amount as a percentage of the property's value. A deal financed at 65% LTV has more equity cushion than one at 80% LTV. Higher LTV means higher leverage, which amplifies both gains and losses. A deal at 80% LTV with flat rents and a modestly rising cap rate can wipe out LP equity at exit. A deal at 60% LTV has significant cushion for underperformance. Also look at, is the debt fixed or floating? What's the maturity date relative to the projected hold? A 3-year loan on a 5-year projected hold requires a refinance at the midpoint, introducing rate and market risk. Any deal with floating rate debt was underwritten in a very different interest rate environment than we're in now. Ask what the current interest rate is, what the cap structure is, and what happens to cash flow if the rate moves up by 100 basis points. Number 7, Projected Equity Multiple. This is the total cash return to LPs divided by total cash invested, including distributions during the hold plus the exit distribution. A 1.8x equity multiple means you receive $1.80 for every $1 invested. A 2.0x is doubling your money. Equity multiple is cleaner than IRR for comparing deals across different hold periods. A 2.0x in 4 years is a different proposition than a 2.0x in 7 years, the IRR is very different, but the equity multiple lets you compare absolute value created. Stress test the equity multiple. If the exit cap rate is 100 basis points higher than projected, what does the equity multiple become? If rent growth comes in at 0 instead of 3%, what does the equity multiple become? A deal whose equity multiple collapses to 1.1x under mild stress has thin margins. Number 8, Total Equity Raise and LP Ownership Percentage. How much equity is the GP raising, and what percentage of the LLC does LP equity represent? A deal raising $2 million in LP equity where LPs own 90% of the LLC returns more value per dollar than the same deal where LPs own 70%. The GPs co-invest and their ownership share matter. Also, how much has the GP co-invested? A GP who invests 5% of the equity raise alongside LPs has more skin in the game than one who invests 1%. Ask what the GP's dollar co-investment is, not just the percentage, which can sound large on a small base. Number 9, Projected Cash-on-Cash Return. Cash-on-cash return is the annual distribution as a percentage of your invested capital. If you invest $100,000 and receive $6,000 per year in distributions, your cash-on-cash is 6%. This is the number that tells you what you'll actually receive in your bank account during the hold, separate from the equity you'll get at exit. Be cautious of deals that show high projected cash-on-cash in years 1 and 2 before the renovation is complete. That's often a return of capital distribution, not a cash flow distribution. Ask how the cash-on-cash is funded in the pre-stabilization period, operating income, or capital reserves. Number 10, the timeline. When does the renovation complete? When do distributions start? When is the projected exit? Every delay in the renovation timeline delays stabilization. Every delay in stabilization delays distributions. And exit timing is one of the most important drivers of IRR. A deal that projects a 4-year exit but runs to 6 years shows a materially lower IRR on the same total proceeds. Ask, what is the critical path on the renovation? What could cause it to run long? What's the GP's plan if the market softens before the projected exit? How to use these 10 numbers together. When you look at a deal summary, map these 10 numbers first, before you read the projected returns section. Use them to build your own view of the deal's logic. Is the purchase price justified by the market? Is the exit cap conservative or optimistic? Does the DSCR at stabilization leave real cushion? Is the debt structure matched to the hold timeline? If you can answer those questions, you'll read the projected returns section with the right context. A 15% projected IRR on a conservatively underwritten deal is more credible than a 19% IRR on a deal with aggressive assumptions across the board. Here's the summary. 10 numbers that tell you what's under the headline in any deal summary. 1. Purchase price per unit or square foot versus market comps. 2. Going-in cap rate versus submarket average. 3. Exit cap rate assumption, and whether it's conservative. 4. Projected rent growth versus actual market data. 5. DSCR at stabilization, should be above 1.25. 6. LTV, loan type, and maturity date. 7. Equity multiple under base and stress scenarios. 8. Total equity raise and GP co-investment. 9. Projected cash on cash and how it's funded. 10. Renovation timeline and exit timing assumptions. Read these before you look at the projected returns. They tell you whether the headline is credible. The LP due diligence checklist has a full deal summary analysis section with a 10-number worksheet, linked in the description. Subscribe for the next one. We're going to cover real estate asset classes, multifamily versus self-storage versus industrial, and how each works as a passive LP investment. Thanks.